Hello and welcome to the MikoBits show, and I am your host, MikoBits. Today we have another exciting episode for you. I have Brian Spector, who is the founder of Qredo. So Qredo is an important, amazing, and deep cryptography project, and it's working on an idea that I like to think of as institutional DeFi. So the question becomes, hey, what does that really mean? So before we get into it, I just wanted to comment that this video is for information and entertainment purposes. It's definitely not intended to be investment advice. We are going to talk about DeFi protocols, and so seek a duly licensed professional if you want investment advice. Further disclaimer, my venture fund, Gumi Cryptos Capital, is invested in Qredo. So, just want you all to understand those basics. So, what I wanted to talk about really quickly is, how the model of custody is changing in cryptographic assets. And I think what we're going to learn from Brian is a little bit about what their technology is doing to transform the sophistication level and the available cryptography for this kind of custody problem in crypto. So let's get into it. But before we start, if you're interested in Bitcoin and blockchain, please consider clicking that subscribe button and also click the bell so you can get notifications about future videos that I might post. Thank you. So let's get straight to the show. So Brian Spector, welcome to the MikoBits show.
Thank you for having me, sir. It's a pleasure to be here on this hot, sultry night in London, England.
Okay,
fantastic.
Yeah.
I hope the weather is great and fantastic where you are too.
It's sunny California.
All right. Yeah, it's I think I'm a little overheated because I'm looking at the action going on in the Wi-Fi balancer pool and all this stuff going on Curve, and I'm like, I think we live in an alternate universe here, man. What is going on? I checked the contracts on Etherscan and I was like, this thing has 330 million in it. And I cannot believe how big this and fast this whole space is blowing up.
Yeah, Wi-Fi is an incredibly interesting protocol. And of course, one of the things that's amazing that I've been joking with people about on crypto Twitter is I've been joking with people about, I think today I tweeted out, I can't wait to use my governance tokens from DeFi to vote on improvement projects, project improvement proposals, right? And then said no one ever, right? I mean, it's really, it's crazy, right? Like, I mean, people are buying Wi-Fi, which is a governance token, and they're kind of pumping the price up. So what's your take on all this?
I'm every day I'm sort of blown away by something new. I mean, like, I looked and it's gone up to like $1,200. And like, Andre even says like, this thing has zero value, right? Like, I mean, and I think his meme is like test in production. So, it's, I mean, the fact that he's got 330 million in there, but his meme is saying, test in production, which basically means like I haven't QA'd this contract, right? Which of course didn't stop me from putting a little bit of money into the whole thing because I'm just insanely reckless, and I hope my wife doesn't hear that. So, but it kind of just shows you the power of the speculative nature of where people are looking to make money and have economic opportunity, and the fact that in our current financial system these kinds of opportunities are so rare and far between that people will gravitate towards these kinds of new and open and accessible protocols and programmable money because if you have the ability to read the code in the contract and you can parse exactly what it's saying, then actually it made a ton of sense. And you were sort of like, okay, well, this is a pretty interesting mechanism here to create this sort of liquidity feedback loop. And a speculator in me would say, well, there's a big chance that this thing will go up. I was shocked by how much, but people are looking for yield, and we got to put food on the table and that kind of thing. So it's not surprising that the space is exploding. It's exploding in ways I didn't anticipate, and in sort of dimensions that are really unusual and strange. But I mean, that's what makes it an exciting time to be in this space and just to just be alive in general. If you're working in the crypto space.
It's super exciting. It's really fun for my show. I had Nodar Janashia from Zapper Protocol on.
I love Zapper.
I'm gonna have Stani from Aave, the Lend token. So we're gonna have some great DeFi guests on our show. So, I'm very excited. We're going to have Teller Protocol on. So we're definitely kind of going through the paces here, getting some of the giants of the space to kind of speak to the excitement that's happening. So, I really, I'm excited about decentralized finance. So what I'd love to understand a bit is, you're the founder of a company called Qredo. So, just tell us a little bit about what you're working on, and then we can kind of fold it back into this DeFi conversation.
Sure. So we started off, so we're a team of cryptographers. My last company I built up was a company that sold basically software development kits to do embedded cryptography in silicon. So we sold them to chip manufacturers like IBM and Intel and Schlumberger and Siemens, and this kind of, my company was starting to just kind of turn the corner as when the cryptocurrency and sort of first wave exploded. And at that point, I sort of had this existential crisis. I'm like, I really want to get into this space, and I'm selling low level, run times to chip companies. Just like, oh my God, what am I doing with my life? I finally exited out of that company in 2016, and the guys that the cryptographers that helped me build that company, we all collectively said, we want to jump into the cryptocurrency space. What's the big $1 billion problem that we can solve? So we started taking a look at kind of custody, which is, at the time, it was really sort of focused around how big and secure my ultra, dungeon-like layer of a vault is, where I can print off your private key, put it on a piece of paper, put it behind, in a Faraday bag, and, in some bomb-proof enclosure. And that's, the best security that you're ever going to get.
I don't know if my audience is that familiar with kind of bank-grade security, but, one of my friends actually used to be one of, I think, 5 key holders for Wells Fargo Bank, and they're prodigious users of paper wallets, right? They use kind of safe deposit. They use sort of, it's a lot like Mission Impossible. They have those kind of laser protected rooms.
Totally.
It's all exactly, that's what that stuff looks like professionally.
Yeah, but it's complete theater. It's total theater. It doesn't bring you any additional security. It's almost like we've taken a step backwards, because here we got this programmable decentralized money, but let's go ahead and centralize the storage of these private keys into one entity's operation.
You're talking about like a Binance.
Yeah, well, I just basically any custodial operation.
Or
Coinbase. I don't want to single anybody out.
I do.
Okay. Yeah, I mean, like Zappo, which got sold to Coinbase. Great example, right? They painted this mythology. It's like, on their website, they had like the picture of the steel vaults and the Swiss bunkers and the disused military silos in the Alps. And I was like, woo, that's like amazing. But there's no way to actually protect against the people element, and the insider threat. And, these are really complex systems that when you start getting humans involved, it really is it's very, very hard to control. It's like that scene in Jurassic Park where, Jeff Goldblum's character is like, yes, oh my God, you brought back the dinosaurs. Life will find a way.
Yeah. Well, absolutely.
Mistakes will happen when you've got people involved. And if you know anything about enterprise cybersecurity architecture, or kind of having grown up in, I guess, enterprise cryptography, you would never centralize all your private keys in one centralized storage medium like that. That's just bonkers. And so we were kind of going like, is this the best that this industry has? There's got to be a better way than doing this. And so about this time, a body of academic research started coming out called multi-party computation.
Yeah,
Well, actually,
yeah,
multi-party computation has been around for a while, but
Sure.
it was this particular body of research about multi-party computation that was being applied towards cryptocurrency wallets, which me and my team started getting really excited about. So it's probably worth like mentioning, what is multi-party computation? What does MPC stand for?
Yep.
So this gets wacky. This starts going down like the Alice in Wonderland rabbit hole a little bit, and I hope I don't turn anybody off. But at a real basic level, when you open up a Bitcoin wallet like Electrum on your desktop, right? There's a private key that controls the actions of your Bitcoin wallet. And basically, you have to sign a transaction, create an electronic digital signature with that private key, and put it on a Bitcoin transaction. So now it's got this signature, and then you feed it to the Bitcoin network, and the Bitcoin validators or miners or other nodes basically will look at the public key, verify the signature, and say, okay, yeah, that thing was created by a private key. It's a legitimate transaction. The UTXO is there, et cetera, et cetera.
Sure.
Let's send it on its way. But at the core of it is that signature. Now, that's also where, people require, you have to use this private key, right, to generate this signature, which is now you've got this custody problem, and it's really hard to manage these private keys, et cetera, et cetera. So what MPC does is it is now the second way you can generate a signature, a digital signature, as if you had a private key in your hand, but no private key exists. Sure. So it is as big a breakthrough as public-private key cryptography, but what it enables you to do, what it enables a group of computers to do, is collectively start talking to each other. And let's say these computers are spread all over the world in different data centers or whatever. It's like we start throwing big prime numbers back and forth at each other, and you run about halfway through the protocol, and what will happen is you generate a public key, just as if I was sitting at my computer with my Electrum wallet with a private key, and then it generated a public key. Sure. But no private key ever existed. It's just these network of computers kind of talking to each other.
Sure.
Out comes a public key. And if they keep running the protocol and you all input the same thing to be signed, like a Bitcoin transaction, at the end of the protocol run, you will get a signed Bitcoin transaction without a private key ever having existed. And then this is the crazy part, right? You feed that signed Bitcoin transaction to the Bitcoin network, and it goes, this is cool. This looks, touches, smells, tastes just like it was signed with a private key, even validates with a public key. But again, no private key ever existed. Now, the audience out there is probably going like, well, so what? Well, the so what is that when you have a private key and you have that kind of centralized cryptographic primitive, like one thing, like a key on your key ring, and I steal the key on your key ring, I got a car. But if I actually have to go and break into like 10 different people's houses and grab their key rings in order to make the key that starts your car, it's orders of magnitude harder to hack and break.
It's like launching the nuclear missiles, right? You need all the keys.
Totally. So this body of academic work that started really getting produced around 2016, we all just got really turned on by, and we're like, damn, this is a way to actually solve the custody problem. Because the other big problem that you have is when you enroll the services of a custodian in the cryptocurrency world, it's not like I hand them my private key and go, hey man, hold this private key for me, like a gold bar custodian, like I take my gold bar to a custodian, I'd be like, hey dude, hold this for me. That doesn't happen in crypto. In crypto, what actually happens is, in order to engage the services of a custodian, I actually have to action a transaction on the Bitcoin blockchain and send them all of my Bitcoin.
Yeah.
So it's not like they're even like storing my private key securely. They're
No, it's
storing their
theirs.
private key. Yeah, exactly.
Agree.
So that's not even like a regular custodian. That's a bank. That's like a depository organization. And so we just thought, God, the inappropriate levels of trust that you have to hand over to these organizations who are, by and large, at that time, weren't even regulated. It's just like, there's got to be a better way.
It's the thing that's amazing to me is that like Satoshi solved the problem of third-party trust from the perspective of the fabric of a transaction network, right? So if you look at it from the network fabric is trustless, right? In quotes, it's trustless, right? But the thing that he did not solve whatsoever is the custody issue, right? Which is that
it's key management.
Because the law, there's only 2 laws of Bitcoin that every single security problem of Bitcoin have all gone through, these 2 fundamental laws, which is just public-private, right? Which is that if you send someone a Bitcoin, like whoever it was that was is going to get the Bitcoin, and it's pretty irrevocable, right? So that's one of the laws, which is be sure you're sending to the right place, right? That's A. And then the private key, the law of the private key, right? Which is if someone has a copy of the private key or the only private key, whoever has the key is the owner. Like that's full stop. There's nothing else to say, right? So, to me, Qredo sounds like a fundamental base layer innovation on top of what Satoshi has to offer, right? Because he's very interested in decentralization. He's very interested in kind of trustlessness, but he really didn't solve a problem on the layer of like asserting ownership over cryptographic assets.
No, but you know what? I mean, let's give the guy a break. Okay, so he solved the major one little thing like programmable money. Okay, all right. So, but then he left this massive, gaping hole as big as a barn door around how do you secure the cryptographic primitives that make that whole system sing,
to me, like it's fine. And the reason why it's fine is I'm very focused on white papers that present what I call the problem solution dyad, right? And so if you look at the problem solution dyad, what he asserted was very simple, right? Which is he said, well, look, we're trying to get a peer-to-peer electronic cash, right? That's the economic pain, right? The discomfort. But we want it to have not have a dependency on the need for trust in a third-party intermediary, right? So he's really asserting that. Now, the thing that's so amazing to me about the Qredo technology that you're describing with MPC is that it so spiritually and logically extends Bitcoin, right? Because, what he's saying, well, in order for us to transact, right, that's one topic where you need an intermediary. So the question is, can we have an intermediary, but can it be trustless? Right. So then the thing that's important to understand is that there's an entire other domain that's not about transaction processing. It's actually about custody. It's about who owns the thing, right? And that feels like something that desperately needs a better solution involving something that's more trustless the way that you're describing.
So thank you. That's what we've been working on, basically. So we kind of just dived headfirst into this MPC world. And then it was like all of us going down the rabbit hole. So it's, I've got a really talented team behind me. And as we kind of got to grips with understanding all of this, we're like, God, this is fundamentally going to change the game on custody. But custody brought forth another bad thing into the cryptocurrency world. It wasn't just that, hey, let's centralize and hoover up all the liquidity into this kind of walled garden, right? The other thing it did is once you remitted your units of value into that walled garden under the premise that, hey, man, they can take care of their private keys better than I can take care of my private keys, it was really hard to get your liquidity out. It's not, you'd have to go through, okay, I got to call somebody, just like a normal custodian. But the problem is you lost the immediacy and accessibility of your units of value. So you can't trade, you can't stake, you can't, all these things that are exploding in DeFi now. If you've got those assets locked up in a traditional kind of cryptocurrency custodian, like cold storage, it ain't happening. You can't get your assets to engage in those economic opportunities. Exactly. So that's the huge issue. That's actually the unintended consequence of what has really kind of been proliferating in cold storage since 2014. And so we started kind of double clicking down on that. And like, any good product manager, I started going to basically big institutional players like, okay, why aren't you investing in the cryptocurrency space? What is it about cryptocurrency custody that is, turning you off? And it was all about that. It was about, so we don't know these guys. We don't know what kind of systems they have in place. There's no way to audit what they're doing, in terms of the efficacy of their operations. And it's just it's a black box. And plus, if we put our assets in that black box, they're really hard to get out. So no thanks. We'll continue to trade stocks and bonds. So the mission that we took upon ourselves was, can we design a custodial platform that actually steals the best bits from blockchain in terms of using a consensus mechanism to drive an MPC network?
Yep.
Basically, could we use another blockchain to serve as an oracle that would drive that collection of decentralized computers to do something like either make a public key so we can make a wallet address, or to generate a signature?
I'm with you 100%, except for the one bit where you said oracle. I think that's a crappy word to describe it.
Yeah, it's gotten a bad, you know what? Because I don't know of any other word to
don't use that word.
All right. Yeah, you've actually slapped my wrist before on this.
Well, let me tell you why I object to it. Let me tell you why. Is that oracles are used for moving off-chain, weakly proven data onto a blockchain in order to perform things like computation, trusted computation, right? And so because of that, an oracle is sort of intrinsically weak, and fundamentally actually unsolvable part of blockchain, right? And when I say fundamentally unsolvable, what I'm talking about is kind of, the laws of physics and information theory, right? Like this has been well addressed by like Claude Shannon and, by Werner von Heisenberg, like it's super clear that you can't solve the oracle's problem in the general case, right? So
no, you can't.
It's unsolvable. So my point is, you shouldn't declare it unsolvable when you've solved it.
Oh, help me out. What do I got?
You shouldn't call it that. You should call it something better.
It's basically a blockchain, what it is. So okay. So
it's blockchain with multi-party compute.
Yeah. So can these multi-party computation nodes that by themselves, in and of themselves, they are decentralized, right? Because that's, you have to for multi-party computation.
Yeah.
Can they be driven by the actions of what is actually taking place in a blockchain? And that is the design ethos that we undertook. We're like, okay, actually, what's really interesting is that if you take away the uncertainty of who's actually controlling these nodes, so that you make them programmable vis-a-vis by what's happening on the blockchain in an immutable layer, and you have trust in that blockchain, then this thing, becomes incredibly ultra secure, particularly if you start applying incentives and rewards around the validators who are running this particular blockchain.
Sure. So you're really talking about a consensus network that is providing a service of multi-party computation in service of kind of creating kind of cryptographic determination of custody. So I guess for me, the thing that is, I think, really important to kind of get to now is, I think for the audience who's sort of relatively new, this is sort of a Harry Potter mumbo jumbo, but I would say that the thing that I'd love for you to dig into next is kind of like, so what are the implications, right? So what I'd like to kind of talk about is I'd like to talk about something that I like to call institutional DeFi, right? Because to me, the thing that's really interesting about what's happened with cryptographic exchanges is the problem that you've effectively solved is this binary problem. And the binary problem is that you have a thing called the private key. Whoever has the key, or however many copies of the key, like whoever has a copy of the key is the owner, right? According to the blockchain. Blockchain perceives that person as the owner, right? So what you've done is you actually created a scenario where there isn't that kind of unitary owner. And so then the question becomes, well, what are some really interesting side effects? What are the beneficial side effects of not having that problem, right? Because to me, like, it's like in a video game, if you have like this magic key, like it's got like holy light shining on it, and when you hand it to the other person, it plays this music and like there's a light shining off this key, right? Because something really crazy is happening, right? Like it's like Excalibur, right? So I guess.
So you brought up Harry Potter because it's so funny because you know what the Horcrux is in Harry Potter, right?
Absolutely.
Okay. We almost named the company like Horcrux, and we're like, nah, J.K. Rowling's going to sue us because we can't do that. This is where it starts to get really, really weird. So imagine you create a wallet with this consensus-driven MPC network, and somebody funds the wallet with, let's do easy math, 100 UTXO. Like, if you use the underlying base accounting mechanism of the underlying asset that you're going to use, right? So if you had this other blockchain that effectively was tracking an ownership right over that 100 UTXO, then it starts to get really, really interesting. Then I could go, you know what? I'm going to transfer some of this UTXO from me to you, Miko. And I'm going to create a digital signature. We were talking about public-private key, but let's just say for easy sake of understandability, I do have a public-private key pair, but it's a special kind of private key that I use to sign transactions on this blockchain that basically give instructions to this MPC network. So that doesn't have any keys. So I go ahead and I sign that transaction. The validators on this network go, yeah, all right, yeah. Brian actually now just sent 50 of that 100 UTXO over to Miko. The interesting thing that's happened here is basically if you go to that MPC network now and say, hey, boys, I want you guys to collectively form an opinion, get consensus, determine by looking at the blockchain that I am the owner of 50 of this UTXO, and generate me a signature on the Bitcoin blockchain because I want to send this off to my Ledger wallet or, my mom who's not on the Qredo network. Yeah, settlement, right? Let's do a settlement transaction, moving that UTXO out of a Qredo instantiated wallet. Well, that's exactly what those MPC nodes are going to do. So when I tell people this, sometimes they're like, that's impossible. You can't split UTXO into the transaction. What are you doing, man? You selling off half the key and give somebody half the key? And it's like, no, this is possible because no key actually exists. And so that has implications in really kind of two ways. One is that if you have a fast finality blockchain, a different kind of blockchain that's not dependent on proof of work, and you're willing to accept some trade-offs for performance, and you actually make it very, very specific as to what the use case problem that you're solving is, this becomes a mechanism for really, really solving the problem of fast payment and delivery of digital assets.
Yeah.
You create a secondary highway in which these digital assets can move from one party to another counterparty. So that is a
so the first thing you get like massive performance. So that's one benefit. So great, good. So let's continue to kind of enumerate benefits, right? Because obviously you kind of described this kind of Horcrux concept, right? So that's definitely a good thing because there's kind of this traditional notion that like ownership is this kind of black or white thing, right? But obviously you've created a much more sophisticated concept of ownership. So what else do you get out of this paradigm?
Well, the other thing that you can get out of this, there's a couple more things, but the other thing that you can get on this paradigm is that you can now start applying this to DeFi. So just as a simple example, one of the big problems in DeFi, of course, is who's got the admin key to the smart contract, right? Yeah. So now you can have a secondary set of rules and consensus drivers that basically say, okay, there's a super layer of basically administrative functions that kick into gear upon these certain things happening, that if this and only these mechanisms happen, we will go ahead and generate a signature that either closes down the contract or invokes some other thing or moves funds or upgrades the contract, whatever we have to do.
That's right.
But if and only if a quorum of other folks agree to this,
Yeah,
and
yeah,
that
yeah. So I like what you're saying, right? You're talking about a kind of a Horcrux, right? Because the thing that people saw in one of my videos, I described a smart contract as being a vending machine, right? And the thing that's so interesting about vending machines is that, like, what are the stakes? Typically, the stakes in a vending machine are like, oh, I put in $1.25 and now I want my granola bar, and then the granola bar doesn't come out of the vending machine, so you're like, yeah, I'm gonna shake the machine, the thing's
which
hanging,
always
it's
works.
hanging
Yeah,
by that little curly metal hook, and you're just trying to get the thing,
yeah.
but like. But there's smart contracts out there that are holding, like, in things like
Like
the compound.
$330 million, right?
Yeah, exactly.
Yeah.
That's yeah, exactly. So the point is that, like, the worst case scenario is when you call the janitor, and the janitor rolls up, and the janitor's got this keychain, and he's got like these 300 keys on it to everything, and then he like finds the key to the vending machine and he opens it up, right? But like, the problem with that is if the vending machine has got $300 million sitting in it, like, you don't want some dude to roll up and just open it on one fine day, right?
Exactly.
And maybe it's the guy who loads the vending machine with candy or whatever, like maybe that's the application. But like, why should that person have like unlimited power over everyone? That just feels a little awkward.
Yeah, it's one of these things about like this explosion to DeFi. I'm just like, dude, I cannot believe this is happening. So that's a huge use case, right?
Yeah.
Like if you're going to attract institutional money,
Yes,
the
that's
kind
huge.
of money into this market that comes from Fidelity, that comes from CalPERS, that comes from State Street, right? We're talking real money, like not the, I don't know, whatever it is now, 250 billion market cap,
I
but
mean,
like
there's
guys that,
there's ether super whales that have kind of institutional class amounts of money, but it's ether. I mean, it's
yeah,
not
well,
new green U.S. dollar money coming into this picture.
imagine if 1% of the FX market could migrate into the DeFi market. What happens then, right? Like it will dwarf the current market cap and expand it by several orders of magnitude. Just 1% of the FX market, but they're never going to come in to this market if the guy controlling the admin key is the freaking janitor, right?
Yeah,
Like
yeah,
they
and not
don't.
and not it's not totally pejorative in the sense that, like, obviously.
No offense to like my school janitor or
Yeah, but
anything like that. Like,
but the model is that, right? That's the same model. It's the same model, right? So the if institutions look at that model, they're just like, that's crazy. Like, why would we
what?
do that? Like, why
There
would
were,
it's a
they
phrase?
could never do that.
Yeah, well,
It
and it's
could
the phrase is counterparty risk, right? Like, it's basically
exactly.
that's the issue. The issue is why would I agree to that? That's insane. Like, that's really.
You would never get it past the compliance department
No, and
ever.
if you did, they should all be fired because
Yeah.
it makes no
It doesn't.
sense.
Yeah, it's just like it makes no sense. Exactly. It's
I mean,
that.
what
What was
happens?
that movie?
It's like that whole like Excalibur key moment in this fictitious movie, right? Which is, like, here's the golden key, it's all glowing, and the holy
Yeah.
music is playing,
This
and you're
Lady of
handing
the
it
Lake
over.
comes out, and you're
Yeah,
like, man, this is
exactly.
weird.
It's kind of like, do we want to hand? It's like the keys to the kingdom, right? It's like, why are we handing that to some random person like that? That feels bad, like.
Right, exactly. So it's kind of the same thing that kind of goes all over crypto. I mean, there's all this kind of basically weird architecture that when you have a serious, institutional regulated player and they're out there and they want to come into this market, it's those things that they come across. It's like, God, this, we love the whole concept of, the aggregating the yield and doing all these things, but they could never come in knowing that, there's one guy that's got control of the admin key or whoever it is, that there's actually no sort of audited consensus mechanism that is enabled that will drive a collection of computers to generate the signature that controls that contract.
So let me kind of poke at you a little one more about this thing, right? But I guess before I do that, you said that there's many things, right? So, obviously the custody kind of problem, which kind of relates to this almost multi-sig mindset around kind of securing institutional grade assets, is one. The other one is obviously like crazy performance, right? But are there more kind of like side benefits that emerge out of
Yeah,
this?
I will tell you the biggest benefit that
Ooh,
you can get by something like
okay.
this, and
Go ahead.
it's super boring concept.
Ha.
It's called trade credit.
Okay.
It's like two mundane words, like trade credit. What's that? Well, okay, so here's another crazy thing about the crypto industry, right? You ever watch Billions? You ever watch the show
I
Billions? You know,
never
where
saw
acts
that.
from, okay, so it's great scene where like this guy's running a hedge fund and he's always calling up his prime broker who has to front him the money to trade on a stock exchange, right? And that's how hedge funds trade stocks and bonds and fiat currencies on exchanges.
Yeah.
They, in the cryptocurrency world, we're the only financial mechanism or medium of exchange where in order to trade on an exchange, I have to send them my assets. Now
Yeah.
imagine if you were
That's
trading
crazy.
stocks and you have to send the New York Stock Exchange your assets.
Yeah.
Like, it's crazy.
Well, I think the thing that's crazy, the thing that's really crazy too, is that that it doesn't actually even come with like a contract that provides legal protection, right? So if you
they're
read,
unregulated institutions.
yeah, if you read the user agreements of these exchanges, like a Binance or a Coinbase, like if you read the user agreements basically say you have no rights and you can lose everything. And
yeah, but if you lose everything, we agree to one arbitration hearing. Good luck.
Not our fault.
Yeah.
So, those agreements are crazy, right? So as far as legal protection, like when you're handing over that Excalibur key, like bye-bye, right? Like that. So what you're saying is that an institution can trade on their favorite exchange, but without pre-funding the wallet, right? So they hang on to their funds
so imagine if we could, like, basically what this system makes available is the fact that I can create a wallet, I can put Ethereum and Bitcoin and whatever else I want in it. And because of the nature of the way this thing is architected, I can essentially enable a counterparty to have a view, an up to the block current view of what's in those assets, and basically give me trade credit on those assets. So for the first time, essentially an exchange, a cryptocurrency exchange could say, look, I'm connected to your wallet and that I have a view into it. I will have a mechanism where I can get alerted immediately if there's any change in balance in that wallet, and I can extend you credit for those assets in the wallet.
Here's what I love about what you're saying, right? Which is what I love about what you're saying is that the traditional world of cryptocurrency exchange has been kind of like split into two columns, right? The two columns are this kind of so-called DEX column, and then there's this so-called SEX column or centralized exchange column, right? Like these two columns are like diametrically opposed concepts, but like they're both wrong. So the thing that's really interesting to me is when you look at things like so when you look at DEX, like you're seeing these emergent kind of liquidity pooling mechanisms like Balancer.
All these automated market making and constant product market making algorithms
which
are fascinating.
Magnificent, right? And it goes back to kind of Bancor protocol. It goes back to Uniswap, and it goes back to all these kind of like basic mechanisms or mechanics for doing these swaps, right? But the thing that's so interesting is that that's nothing like the kind of financial trading that you see, on what are primarily so-called centralized exchanges, right? So the thing that's so interesting about what you're describing in this case is you're describing a use case that is essentially like an institutional DeFi, right? Because when you look at the user experiences of so-called decentralized exchanges so far, like you get these really interesting hybrids like IDEX, I'm friends with Alex and it's a good exchange experience, but like when you go into the DeFi world, you end up with stuff like 1inch, and you end up with stuff that just really
which I love.
Curve, which is awesome. Curve is awesome, but like, look
that is the most brilliant hot mess of a UI I have ever seen. I want to party with the cowboy that wrote that UI.
What I love about 1inch are the flames. That's just great. It's so awesome. But now take that interface over to like Goldman Sachs and try to get their like FX
guys,
desk.
I want you to put 300 million in here.
You know what's funny? The thing that's funny is that it's clearly you're asking the wrong guys, right? Like there are guys that have put 300 million in there.
Totally. Like there's like I know a buddy who knows this whale. He's like basically getting like 50 grand a day off the off that balancer pool.
Yeah.
You know what I mean?
Yeah.
I'm
It's
just
terrific.
like,
It's terrific. It's great.
Yeah.
Right? But the point that I'm making here is that like what you've effectively separated is you've effectively separated the user experience layer from the custody layer, right? So now you can basically take any user interface, right? And you can kind of, without having to hand over your asset, you can basically now kind of trade, right? So you're effectively kind of depositing into something that's more like a smart contract, the way that you would in a DEX context, right? So you're really
we did
not
something.
pre-funding the wallet.
You're not pre-funding wallets anymore. You don't have to on this system. You don't have to pre-fund wallets. We intentionally designed a very almost brutally minimalist kind of consensus rule set, knowing it would drive this MPC network.
Yeah.
But the other thing is we purposely chose not to create our own currency. So what we did is we basically programmed into the consensus rule set a minimal basis point charge of whatever you're moving across the network in the context of an ownership right. So if I move, 500 Bitcoin from me to you, it's 5 basis points.
So I see what you can do for someone like a Goldman Sachs or like a traditional hedge fund trading desk that wants to get into the crypto space. I totally see what you can do, right? Which is you can really enable them to have the institutional grade security and custody that they're accustomed to, right? And so that's super powerful, right? And that enables them to kind of use their choice of any kind of exchange infrastructure without suffering the counterparty risk. So like that's awesome, right? I can totally see also what you can do for these centralized exchanges, which you can offer them a whole bunch of new customers that can come in that are kind of worried about the custody model, that refuse to accept the one that exists. But what I'd love to have you kind of reason about is, what can you do for the DeFi world? It feels like there's some great opportunities in
So everything on, okay, so without giving the game away, everything on and I'll try and dance around it. So everything in our network is expressed as an ownership right, which in itself is kind of a form of derivative, right? So imagine you had a Qredo wallet that was completely multi-asset. You could, not that this is like, any big shakes, but you could effectively print off a fungible token that effectively says, well, this ownership right is entitled to these assets. And with an off-chain oracle that can give you pricing information, you can constantly carry around these units of value with you across multiple different chains. So now if I actually want to print that unit of value off as a token on Ethereum, I could do it as an ERC20, but I could also go cross-chain and do it on EOS if I wanted to. So there's this symbiotic relationship that you're going to be able to get, where if you're hunting for yield, you can do it. Obviously, Ethereum's got quite the economic opportunities kind of locked up right now. But that's not to say that there are not other places on other chains where you're going to be able to take that and run the ball on some pretty crazy things that will happen. That we are sure something's going to happen on, probably one of the other supposed Ethereum killers, right? So there will be economic opportunities other than just on that one chain with that one specific token type. So it's really.
So how do I get the Qredo token?
The governance token or the Q token?
Oh,
so
yeah.
now you're making me give the game away, dude.
Okay, sounds
so good. We were going to reward users of our platform, obviously.
Great.
And the governance token will, enable you to stake, run validators. But going back to the thing I said earlier, the interesting thing, and I think hopefully the thing that if we kind of have a lasting impact, what I'd like to see is the fact that the architectural decision and the philosophical decision not to have our own coin is the thing that I think will probably, ring true eventually for most people. They'll say that was a pretty pure decision. That in actuality, because the use case was really focused
now it sounds
about.
like you're saying it sounds like you're saying that you're not planning to have one.
We're not planning to have a Qredo currency. We'll have a governance token, but that's not a currency. It's not how you pay for gas.
But it could
right?
be like the Wi-Fi token.
Yeah, sure. We could only be so lucky. So there's a lot of cool stuff coming down the pike. I mean, I don't want to reveal too much before we kind of make the huge impact, but we've got a very specific set of use cases that we solve for the institutional players and just regular retail players that want to secure their assets in a way that enables them to manage their own wallet, engage the services of professional custodians, or bring their own custodians, right? So multi-party computation is going to be the next big breakthrough. In 5 years' time, most wallets won't have private keys in them. I would venture to say that most wallets will be run the way that we will. So, people are probably looking at me when I say that and going, man, you're crazy, but you can take that to the bank. And I think, by expressing things as ownership rights that drive that consensus-led multi-party computation network, you're able to turn around and do amazing things that fix the bottlenecks within the industry that will enable a huge inflow of capital, the likes of which we've never seen. That's what we're trying to do. We love this space, and we want to see it grow and succeed. And we're all motivated, I guess, in our little way to, morph the financial system into something more true, more fair, more honest, therefore, I think that brings a greater level of prosperity to everybody kind of the world over eventually.
No, I like that. And, just the way of characterizing this thing, I don't really take the phrase DeFi lightly, particularly. I think it's a very serious endeavor. Obviously, it's a multi-billion-dollar endeavor. It's a, pretty serious group of, technical people and engineers, but what I can legitimately say is that, this technology of Qredo has a very strong implication. And it actually is a very fundamental technology of cryptography that enables kind of new use cases by essentially extending what Satoshi solved with Bitcoin, right? So really moving this layer of the existence of third-party intermediaries, but eliminating the need for trust in those intermediaries in order to perform a function that's essential for the growth of this market, especially among institutional investors, right? Because, when you look at this peer-to-peer electronic cash use case, that's really just a use case. But the thing that's interesting about the plethora of financial services that can be put into the blockchain world, we obviously need a much superior technology fabric for solving this kind of Satoshi problem, right? Which is essentially the need you have intermediaries, but you don't need to have trust in those intermediaries.
I think, and if you talk to these folks at these large fiduciary institutional investors, the kinds that would bring the kind of remit the kind of economic units into the cryptocurrency space that would increase the overall market cap by orders of magnitude. The thing that they love actually is the trustless nature of it all. And if you can kind of, what we've done is to take the fundamental basics of decentralization and apply that to custody. And
absolutely.
I think
it's a very important innovation. So, I think you can check it out. So Qredo, that's the technology, and
Qredo.com. Thank you for the thank you for the plug, sir. Much
Absolutely.
appreciated.
And, Brian Spector, founder. And so, I feel like we've had a really great, rollicking conversation. Please engage in the comment section. I'm happy to answer any questions or pass them along to Brian, get them answered for you. If you're interested in this kind of content, please subscribe to the channel. And, and also if there's a way for people to follow up with you, obviously Qredo.com, any other social.
Yeah, we just started up the Telegram crew. We're basically kind of emerging, out of the shadows, I guess. Our app, the iOS apps in the App Store, we're Wonderful. In the web interface is in limited preview. We're just ironing a few things out.
Yeah,
we
go
should
check
be
it
live.
out. Qredo.com. Sounds great.
And you can find me on Twitter at bspector, or Qredo.com. And I'd love to hear from anybody. And sir, thank you so much for the great conversation. And I really enjoyed myself. And I'd love to be a guest anytime you want to have me.
Absolutely. Fantastic and super rich insights from a fundamental student of cryptography and a leader in our space. So thanks so much, Brian.
Thanks a lot. Okay, cheers.
Okay, bye.